it appears the Indian markets, they like what global cues came through.
For now, the mid-cap index is holding up quite well. It's a 1.2% gain that we're seeing there.
We have come off the highs as far as the benchmark is concerned.
Well, we started off in the green in the model, but unfortunately we couldn't build onto that, right? We met some bit of resistance at around 19,150.
Good trading session. The market opened well, up almost 140 points. From there was a bit of profit taking.
Hello and welcome to Markets Today. I'm Nigel D'Souza. Let's get straight to the headlines for the day. The last Street ends a steady session at day's high point. The sensex gains nearly 500 points. The nifty reclaims the 19,000 mark. The rupee ends the day with minor gains against the dollar. Tata Motors reports a strong quarter as Jaguar and Land Rover drives the growth. Revenues up 32%. JLR margins expand to nearly 15%, and the company raises the full-year outlook by 200 basis points. Britannia gains despite weak volume growth, but good margin expansion and earlier sell-off in the stock aids sentiment. Dabur gains 3% after the volume growth and margins beat estimates. GCPL also gains on a good quarter. Tata Steel posts lower than expected revenues and margins, hurt primarily by weakness seen in the European operations. The exceptional restructuring and impairment provisions further dent the bottom line. The stock, however, recovers from the day's low as the management guides for a better outlook than earlier perceived. Godrej Properties gains as it reports its highest ever quarterly sales, but GMDC tanks on a weak showing in the second quarter. Hero Motor falls on profit taking after a solid quarter two, while LIC Housing Finance falls on a weak showing in the second quarter. Well, here's the lineup that we have in the next half hour for you. In Market Opinion, we have Nilesh Shah, MD and CEO at Envision Capital. And in Big Corporate Voices, we have TV Narendra, the MD and CEO at Tata Steel, and Anuj Kathuria, the India President at JK Tyre. Well, let's take the markets head on and let's start with the market action itself. After declining for the last two sessions, the stock markets, they clawed back today. The Sensex gained close to around 500 points to get above the 64,000 mark. The Nifty is back over the 19,000 mark as well. Banking stocks, they gained in tandem with the blue chip names, but the mid-caps outperformed, with the mid-caps gaining close to around 1%. The small caps did even better. They were up 1.5%. Prashant Nair joins us to give us a wrap-up of today's action. Prashant?
Well, it was a solid day after the Fed meeting last night gave the indication that maybe, just maybe, the Fed is done. Not just in December, but maybe through the course of the first half of next year, and maybe just done overall with rate hikes. And that is a significant departure. The Fed Chair Powell seemed very comfortable with that idea and that came through his comments. So the markets reacted overnight. The US markets rallied. Yields basically crashed. The 10-year was down some 17 basis points. So it was a positive setup. We started on a pretty buoyant note, and the market stayed like that for the bulk of the session. Never gave up gains, but the only sort of thing to mention is that we didn't build on that on those opening gains. We kind of ended where we started, but it's a solid session nevertheless. The Bank Nifty will come up on your screen. Similar kind of picture there. Strong day. The mid and small cap part of the market did even better, and the small cap index has recovered and retraced the most in terms of its losses. It's been the strongest index amongst the frontline ones. Large cap gainers, Britannia, Hindalco, IndusInd Bank were a few. Apollo Hospitals, UPL and Aisha were the others which did well. In the broader markets, advanced decline, very strong. So REC, PFC, some of these, beaten down names which have done very well recently. Jayaprakash Associates, it's up 90% in the last 10 sessions. JP Power was another one. JK Tyre, Indus Tower, Lodha, which is Macrotech, BHEL, Dawat, Delta Corp, Triveni Turbine. There was RateGain, which was reacting to earnings. Raymond, Cupid, there was KRBL, KDDL, TRF. The breadth of the move was truly impressive across the broader markets. There were some pullbacks as well. GMDC earnings related, Sirma, Karnataka Bank. Actually, most of the hits were on the earnings front. Deepak Fertilizers, Surya Roshni and Thangamayil, with the management with us as well. And the markets were not pleased with the second quarter earnings. Can we build on this in terms of the gains that we've seen as we come back into tomorrow's session? And will the US market provide that continued tailwind? Those are big questions.
Well, that's right, Prashant. At least for now, the global equity markets have read the US Fed's commentary as dovish. But a good time to get you some market opinion. Nilesh Shah, Managing Director and Chief Executive Officer at Envision Capital, said that the market's uptrend is pretty much intact. He added that corporate earnings actually have been phenomenal across sectors, including banks as well. Let's take a look.
Trend was pretty much intact. I think India has demonstrated some really strong performance, both as a market. I think corporate earnings have been phenomenally strong. They have been better than expectations across the board, across sectors. That has been very strong. 10, 15, 20% in the recent months. Banks, again, financials, I think the performance has been stellar. I think it's hard to come across businesses continuously growing at 20, 25%, but stock prices not responding to those kind of earnings. I think HDFC Bank could perform, and we own HDFC Bank, I think could start to outperform when that big bout of liquidity comes in. It's going to be driven a lot by liquidity.
All right. Well, the U.S. Federal Reserve, as expected, left interest rates unchanged for the second consecutive time. The decision also included an upgrade to the committee's general assessment of the economy. Fed Chair Jerome Powell hinted that the central bank may now be finished with the most aggressive tightening cycle in 4 decades. However, Powell said that the Fed is not declaring victory on inflation yet and that there is a long way to go.
The stance of policy is restrictive, meaning that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Inflation has moderated since the middle of last year, and readings over the summer were quite favorable. But a few months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. The process of getting inflation sustainably down to 2% has a long way to go.
Moving on then, Tata Motors, well, that one ended with 1.5% in the green, ahead of its Q2 numbers that just came post-market hours. The company reported strong numbers with JLR driving growth. Parikshit Luthra joins us to fill us in with a quick analysis on those numbers. Parikshit, well, a pretty strong showing there.
Yes, Tata Motors reporting strong earnings in Q2, revenue up 32% year-on-year at 1.05 lakh crore, in line with estimates. EBITDA coming in at 13,767 crores versus a CNBC poll of 13,681 crores. Net profit coming in at 3,764 crores versus a poll of 4,039 crore. What really stood out this time was the strong performance by JLR. Very strong margins, and EBITDA margins up 430 basis points year-on-year at 14.9% versus 10.6% last year. Q2 EBIT for JLR came in at 7.3%, and the company has actually raised guidance for JLR EBIT margins for FY24 to 8% from 6% earlier. The company expects free cash flow of over £2 billion in FY24 and net debt to reduce to less than £1 billion by the end of FY24. In its future outlook, the company has said that it remains optimistic on demand despite external challenges. They anticipate a moderate inflationary environment and aim to deliver a strong H2 with strong demand for JLR models, heavy commercial vehicles, and new generation of passenger vehicles. PB Balaji, the company's CFO, has said they are confident of sustaining growth momentum in H2.
All right, Parikshit, thanks a lot for that. Well, moving to the second headline now. Dabur gained close to around 3% after the firm's volume growth and margins came in better than what the street expected. Mangalam Malu joins us to decode those numbers for us. Mangalam?
As far as Dabur is concerned, the revenue, EBITDA, as well as margins and net profit were above street expectations. Mild beat on the revenue with a growth of about 7% odd. And the EBITDA margins at 20.6% were also above street expectations of 20.1% as well. And the net profit was a 10 crore beat as against expectations, but this also included a one-off legal expense of over 30 crores. So if you adjust for that, it was a much higher beat. Importantly, the volumes, while they came in at 3% versus street expectations of around 4 to 5%, if you adjust for the Badshah acquisition, the volume growth was closer to 6%, 5.8% to be precise. And the management was confident of the second half of this year with, low double-digit to high single-digit sort of revenue growth projections with mid-single-digit volumes and the margins being maintained around that 19.5% mark itself, with strong driver being the food business, which they intend to exit this year with a run rate of 500 crores.
We are looking at a high single to a low double-digit kind of growth in the balance half of the year and gaining market shares across categories. That's what we've done in the previous quarter also. Volume, we're looking at a mid-single-digit kind of a volume growth.
Well, Manglam, stay with us though. Britannia as well was up close to 3%. Despite reporting weaker than expected numbers, the volume growth is a little bit weaker. However, good margin expansion and an earlier sell-off in the stock, I think that's what resulted in the stock doing reasonably well today. Run us through the highlights, Manglam.
Britannia was higher in today's trading session, and this despite a top-line miss. There was a top-line miss largely because of weak consumer sentiment. At the same time, there were strong competitive pressures as well, and the company had to take some price cuts to pass on the benefits of raw material reduction to the consumer. So as a result of which, the revenue of the company grew by just around 1.2%, with 0.2% volume growth as against street expectations of 2 to 3%. But what was really good, and this was really the cream in the middle, was the operating performance. The EBITDA was a good 100 crore above street expectations. Gross margins improved by 400 basis points, and nearly 350 basis points were passed on or flew through to the EBITDA itself, and as a result of which the net profit was above expectations as well. Now, the company said that demand conditions were challenging, especially in the rural part of the country, largely because of the 2-year high inflation that we've been seeing. But they do believe that there are some signs of an uptick given the festive season, and going forward with the company's focus towards new products and adjacencies, maybe there could be some positivity in business going ahead with Britannia's own cost efficiency program. So the outlook was fairly positive as well.
Well, Godrej Consumer as well ended close to 2% high after a strong set of numbers in the second quarter. The company beat estimates on all counts. The profitability rose by 20% on a year-on-year basis, while margins came in at a 19.5%. The domestic volume growth of around 6% almost also beat estimates. Speaking of CNBC-TV18, Mr. Sudhir Sitapati, the MD and CEO, said that the second half of this year will see similar growth as the first half. He also added that the goal was to achieve 10% volume growth. Let's hear him out.
We think we are somewhere between 5 and 10 right now, and our aim is to certainly keep every year moving a little closer and closer to what is our goal. I won't say it's our target, but it's our goal, which is 10% volume growth. One should expect to see some amount of margin expansion for 2-3 years, moving to, let's say, somewhere 22-23 kind of margins.
Well, time to slip into a snappy break. We'll be back with all the other headlines that we're tracking for you. Welcome back. You're tuned in to Markets Today here on CNBC TV18, which brings us to the fourth headline today. Well, Tata Steel's numbers were a little bit disappointing. European business continues to remain under pressure. The stock, though, recovered from the low point of the day. First up, let's run you through the analysis. Well, the headline numbers, that's the revenue, the EBITDA, as well as the margins, well, they missed what we were working with. They also delivered a net loss because there were provisionings and there was impairment cost as well. But that was more or less one-time in nature. On the India business, well, they have merged the long products business with their core business as well. So the standalone numbers on a like-to-like basis, they have regrouped the versus numbers out there. So those numbers were in line, a little bit lower. The NINL acquisition, well, on a sequential basis, it reported a loss in comparison to a profit. Moving to the European business, well, out there, the losses were more than expected, came in at around $155 per ton. We were working with a number of around $140 per ton. And both Netherlands as well as UK, they delivered net losses on the EBITDA per ton front. The Netherlands business, you have realignment of that furnace out there, so that's why that was under pressure. And also, they had high cost of coal inventory. And the UK business, well, conditions on the whole itself are rather weak. The other problem is the net debt numbers now moving towards 77,000 crores odd from around 71,000 crores. Capex spends and higher inventory, that's what hurt them. In fact, I spoke to the management earlier today. Mr. TV Narendran, he gave us an outlook for the second half of the year. Let's hear out what he had to tell me.
It's been a challenging quarter. I think we had guided that it will be a challenging quarter. So coking coal prices, I think, dropped by about $55 to $60 on a consumption basis in Q2 compared to Q1. For India, is expected to go up by about $10 Q3 compared to Q2. As far as Europe is concerned, we had slightly different situations in UK and Netherlands. I think in UK, the drop was about $45 per ton Q2 to Q1. It's going to be about $20 a ton Q3 to Q2. Will drop further. Whereas in Netherlands, the drop in Q2 was a bit less because they were consuming high-cost coal that they had. So the drop was only about $10 Q2 to Q1. Is expected to be about $50, $55 Q3 to Q2. Basically, we're guiding that H2 will be better than H1, and you will start seeing the improvements in Q3 and in Q4. Clearly, in India, as you said, The steel prices have gone up in Q3 compared to Q2. Coking coal prices, consumption basis is going up a bit Q3 to Q2, but the steel prices more than cover for that. And we're waiting to see the pricing outlook for Q4. So I think India, you will see margin expansion. In Europe, you will see margin expansion in Netherlands because one of the challenges that we've had in the last 6 months in Netherlands is the blast furnace 6, which is 40% of our production, has been down for relining. It should come up by the end of November, first week of December latest. And so we will have a normal Q4.
Well, moving to the fifth headline today, Godrej Properties gained close on 3% after reporting a good set of numbers. The company reported its highest ever quarterly sales of around 5,000 crore rupees, with a jump of around 109% in comparison to last year. Sonal Bhutra is with us to fill us in with more details. Sonal?
Well, yes, it was a good set from Godrej Property this time around on a YOY and on a quarter-on-quarter basis. Quarter-on-quarter higher because of a low base, but even YOY it was a strong set. The company has achieved 52% of its FY24 guidance of 14,000 crore rupees in terms of sales in the first half itself. They also say they are on track to meet their FY24 guidance on all parameters. Now, quickly taking a look at the numbers, their Q2 bookings, they have come in higher by 109%. Area sold is up 93% and customer collections are also up 23% on a YOY basis. Their guidance, that's what they say they'll be able to meet, is 14,000 crore rupees in terms of sales, collections of 10,000 crore rupees, deliveries of 12.5 million square feet, and business development of 15,000 crore rupees. Their debt has increased on a quarter-on-quarter basis. Their net gearing also has come in at around 0.7, but the company says these are comfortable levels. So yes, a thumbs up on Godrej Properties numbers this time around.
Thanks a lot for that, Sonal. Well, GMDC, the stock has seen a big jump up. From around that 150 rupees, it moved all the way to around 400 rupees odd. However, the numbers came out and they were far from impressive. And if you look at it in the last 1 month, the stock is corrected from around 420 rupees all the way to around 320 rupees. What went wrong with the numbers? When one factor is, it's a seasonally weak quarter because the mines get flooded, and the heavy rainfall as well hurts them. So on a year-on-year basis, the volumes are down by 20% itself. But the revenues are down by 29%. That's because the realizations as well are likely to come under pressure. Now, besides realizations being down, no operating leverage and input costs going up, the margins came in at its lowest we've seen in multiple quarters, came in only at around 14%. The net profit number as well got some bit of a fillip because they had higher other income. If not for that, the net profit number would look far worse. And both their verticals, whether you're looking at the mining business, where the EBIT number did come down by close to under 100 crores, or you look at the power business, where the EBIT loss more than doubled on a year-on-year basis. All in all, these numbers are disappointing. The way ahead, we'll have to see whether or not the margins recover because second half of the year is traditionally stronger. What's happening with the rare earth opportunity? That's something that the street would like to know. And can we see margins recover? First, for now, though, those numbers go down as a miss. LIC Housing, well, that one as well was down in today's trading session in reaction to its numbers. Surbhi Sutaria joins us to fill us in with a quick analysis on that set. Surbhi?
Thanks so much for that. So LIC Housing Finance had a weak quarter sequentially, but it was better than expectations on the P&L front. Now disbursements were down nearly 13% on a year-on-year basis, up 35% sequentially. AUM was up 6% on a year-on-year basis and flattish sequentially. Individual loans were up 7% on a year-on-year basis, whereas Kotak was estimated close to a 9% growth. The gross NPA ratio has come in at 4.3%. Now P&L is a beat versus our poll. So net interest income is at 2100 odd crores versus a poll of 2035 crores, PAT at 1188 crores versus a poll of 1104 crores. Brokerages are also, they have said that the growth is muted but largely positive. They said the growth is muted at net interest margins at above 3% and return on assets at 1.7%. The home loan disbursements remained weak and fell 12% on a year-on-year basis, and credit costs were contained at 60 basis points. Morgan Stanley has an equal weight rating with a target price of 450. Jefferies and Nomura have a buy rating with a target price of 505 and 550 rupees per share.
Thanks a lot for that, Surbhi. Well, the big corporate story, though, was Zurich International is set to acquire a majority stake in Kotak Mahindra's general insurance arm. The company will invest over 4,000 crore rupees, and the deal is expected to be completed by June next year. Ritu Singh joins us to fill us in with more details. Ritu, run us through the deal contours.
In what is the single largest investment by a global strategic insurer in an Indian non-life insurer, Kotak Mahindra Bank and Zurich Insurance have entered into a definitive agreement for a transaction whereby Zurich is going to invest approximately 4,051 crore rupees to acquire a 51% stake in Kotak General Insurance through a combination of fresh growth capital and share purchase. Further, Zurich is going to acquire an additional stake of 19% within a period of 3 years from the initial acquisition. The proposed transaction values Kotak General Insurance at approximately 7,940 odd crore rupees on a post-money valuation, and the valuation based on gross premium of the company works out to market cap to premium ratio of 6.9x. Now, the initial transaction of 51% stake is expected to be completed by June of next year, and the deal, of course, is going to be subject to various regulatory approvals. Now, with this, Zurich Insurance is also going to be the first foreign insurance company to enter India in the last 8 years. Remember, the FDI limit in insurance was only recently raised to 74% in 2021. Kotak General Insurance business, now it's a small business. It has a 0.5% share in sector premium and forms just 0.3% of Kotak Bank's consolidated net worth. For Kotak Bank, this works out to about 2,442 crores of equity from the transaction, and that would result in the bank's Tier 1 ratio improving by 0.49%.
Thanks a lot for that, Ritu. Well, on that note, though, we'll have to wrap up on this edition of Markets Today. Stay tuned for more news and updates.